Hello viewers, I am Dr.P.James, Assistant Professor of Commerce from St. Joseph's College of Arts and Science Autonomous Cuddalore. In this video, let us discuss about the meaning and objective of auditing. The term audit is derived from the Latin word audire, which means to hear. Auditing is the verification of financial position as disclosed by the financial statements. It is the assessment of accounts to ascertain whether the financial statements provide a fair and true view of the financial position and profit or loss of that concerned organization. Auditing can also be known as the intelligence and critical test of accuracy, dependability, and adequacy of statements and data of accounting. Hence, auditing can be understood as an independent examination of financial information of any organization, whether profit-oriented or not, irrespective of its size and legal form. When such an examination is conducted to express an opinion thereon. The objectives of auditing keep changing according to the advancements in the business techniques. The objective of an audit is to express an opinion on financial statements. Hence, the auditor has to verify the financial statements and books of accounts to certify the truth and fairness of the financial position and operating results of the business. Therefore, the objectives of audit are categorized as primary or main objective, secondary objectives, and specific objectives. The main objective of auditing is to find reliability of financial position and profits and loss statements. The aim is to ensure that the account reveals a true and fair view of the financial position of a business and all of its transactions. The objective is also to verify and establish that at a given date, both profit and loss account and balance sheet presents an accurate and reliable financial position of the business. Hence, the main objective is to form an independent judgment and opinion about the reliability of accounts and truth and fairness of the financial state of affairs and working result of an organization. The secondary objectives of auditing are detection and prevention of errors and detection and prevention of fraud. First, let's have a discussion about detection and prevention of error. What is error? According to the Institute of Chartered Accountants of India, an error is an unintentional mistake in the books of accounts which are made due to carelessness on the part of the person who is preparing books of accounts or committing mistakes in the process of keeping accounting records. Errors which take place in the books of accounts, and the duty of the auditor is to locate such errors and suggest measures for the same. There are 4 types of errors, namely clerical errors, error of duplication, compensating error, and error of principle. Let's discuss one by one. Errors that are committed in posting, totaling, and balancing of accounts are called clerical error. Such errors may or may not affect the agreement of trial balance. It further classified into 2, namely error of omission and commission. When a transaction is not recorded or partially recorded in the books of accounts is known as error of omission. Usually, it arises due to the mistakes of clerks. Such error of omission can occur due to complete omission or partial omission. When a transaction is totally or completely omitted to be recorded in the books of accounts, it's called error of complete omission. Usually, it will not affect the agreement of trial balance. Hence, it is very difficult to an auditor to detect such errors. When a transaction is partly recorded, it is called error of partial omission. Such kind of errors can be detected easily as it will affect the agreement of trial balance. Errors which are not supposed to be committed or done by carelessness are called error of commission. Such errors arise in recording, posting, and casting or carry forward. Then, second type of error is error of duplication. It arises when an entry in the books of original entry has been made twice and has also been posted twice. These errors do not affect the agreement of trial balance, hence it cannot located easily by an auditor. Third type of error is error of compensation or compensating error. When one error on the debit side is compensated by another entry on the credit side to the same extent is called compensating error. They are also called offsetting error. These errors do not affect the agreement of trial balance, hence it cannot be located by an auditor. Then the fourth type of error is error of principle. An error of principle occurs when the generally accepted principles of accounting are not followed while recording the transactions in the books of accounts. These errors may be due to lack of knowledge on accounting principles and concepts. Errors of principle do not affect the trial balance and hence it is very difficult to locate such type of errors by an auditor. The second part of secondary objective of auditing is detection and prevention of frauds. It is one of the foremost subsidiary objectives of auditing, as fraud refers to the intentional or willful misrepresentation of financial information. Thus, detection and prevention of fraud is of great importance and which constitutes an important duty of an auditor. It can be classified into three. One is misappropriation of cash, secondly misappropriation of goods, and third kind of a type of fraud is manipulation of accounts. First, let us see about the first type of fraud, misappropriation of cash. It is a very common method of committing fraud by dishonest employees by giving false representation in the books of accounts with intention. In order to detect and prevent misappropriation, the auditor should verify the system of internal check in operation, and by making a detailed examination of records and documents. Generally, cash may be misappropriated by omitting to enter cash which has been received, sometimes by accounting less amount on the receipt side of cash book than the actual amount received, or by recording fictitious entries on the payment side of cash book, or by accounting more amount on payment side of cash book than the actual amount paid. Sometimes it may happen through teaming and lading of fraud, which means cash received from one customer is misappropriated and remittance received from another debtor is posted to the first debtor's account. Second kind of fraud is misappropriation of goods. Fraud which takes place in respect of goods is misappropriation of goods. Such type of fraud is very difficult to detect and usually takes place where the goods are less bulky and are of high units value. It takes place by showing less amount of purchase than actual purchase in the books of accounts. Sometimes it may happen by showing issue of material more than actual issue made, and some other time by showing good materials as obsolete one or poor line of goods. Sometimes it may happen, it may be shown as fictitious entries in the books of accounts. Detection of misappropriation of goods is a difficult task for an auditor. Only through efficient system of inventory control, periodical stock verification, internal check system as regards stock taking, adequate security arrangement will facilitate that auditor to find such frauds, and such frauds can be eliminated or sometimes minimized. Hence, auditor has to thoroughly scrutinize the inward and outward registers, invoices, sales memos, audit notes to detect such kind of frauds, goods related frauds. Third type of fraud is manipulation of accounts. There is a very common practice almost in every organization by some dishonest employees who is having some intention to commit this type of fraud. Such manipulation of accounts will be done by the top level managerial personnel, which is the procedure to alter the books of accounts in such a way that there will be an increase or decrease in the amount of profit to achieve some personal objectives of the higher officials. It is very difficult for the auditor to identify such frauds which may be due to manipulation of accounts. There are some causes for manipulation of accounts. It may be to get more commission if it is calculated on the basis of profit, for evasion of income tax or sales tax, sometimes to get huge loan from financial institutions by showing more profit in the books of accounts. It may be due to declare more dividend to the shareholder. It may be by showing more profit than actual to get confidence of the shareholders, to make secret reserves by showing less income or by showing more expenses in the books of accounts. And there are some ways to manipulate the accounts. It may be made by showing more or less amount on fixed assets, by showing overvaluation or undervaluation of stocks, liabilities, creation of over or under provision for depreciation, charging capital expenditure as a revenue one, or vice versa. Sometimes by making more or less provision for bad debt and outstanding liabilities, by showing advance income or expenditure in the current year's account. Such manipulation of accounts will be with the object to show or manipulate the financial status in such a way that the window dressing or creating a secret reserve. In window dressing, accounts are manipulated in such a manner to reveal a much better and sound financial position of the business than what actually it is, in order to mislead the outsiders by inflating the profit. And second objective of manipulation is that creation of a secret reserve. In this, accounts are prepared in such a manner that they disclose a worse financial position than the real one. The real picture of the business is concealed and distorted one is revealed. Third objective is specific in its nature. Sometimes audit includes such other areas like review of operation, performance management policy, cost records, and so on. Accordingly, there will be a specific objectives in respect of each type of such a specific audits. For example, take cost audit. It is with an intention to check the cost records of the entity in order to make a proper ascertainment of cost of production of goods and services. Likewise, operational audit, It is done by an auditor to evaluate the existing operation of the existing business organization to give an expert advice to improve their efficiency. Hope you understand the meaning and objective of auditing. Thank you. See you in the next video.